Hello there, future property investors. Scott McGillivray here. Thinking about diving into the Canadian real estate market in 2025? It's a fantastic ambition, and one that can certainly build long-term wealth if you approach it wisely. Canada offers a diverse range of opportunities, from bustling city centers to quieter suburban landscapes. But before you start picturing those rental checks rolling in or your dream home, it's absolutely crucial to understand the costs involved. My goal today is to break it all down for you, nice and simple. We're going to navigate the financial maze of buying property in Canada step by step. We'll look at everything from the initial purchase price to those often overlooked expenses that can catch new investors off guard. Knowledge is power, especially in real estate, and being well-informed from the outset can save you a significant amount of stress and money down the line. Let's make sure your Canadian real estate journey in 2025 begins on solid financial footing, setting you up for potential gains and a rewarding experience. Alright, let's talk numbers. What can you expect to pay for property in Canada in 2025? Well, it's a big country, and prices vary wildly from coast to coast. Major urban centers like Vancouver and Toronto will, unsurprisingly, command the highest prices. For instance, a detached home in these cities could easily set you back anywhere from $1.5 million to well over $2.5 million Canadian dollars. Moving away from these top-tier markets, cities like Calgary, Edmonton, Ottawa, and Montreal offer more accessible price points. In these locations, you might find a detached family home starting in the $600,000 to $900,000 Canadian dollar range. Condominiums in these cities could be found from $350,000 to $600,000 Canadian dollars. Smaller cities and towns or regions further afield can offer significantly lower prices, sometimes under $400,000 Canadian dollars. Thorough research into the specific area you're interested in is paramount. So, we've talked about general price ranges, but what kind of property can you actually get for your money? Let's break down the common types. First up is the detached house. This is often seen as the traditional Canadian dream, your own building on your own plot of land. These offer the most privacy and space, often with a garden and garage. In major cities, as mentioned, these are the priciest options. However, they also tend to appreciate well and offer great potential for adding value through renovations, perhaps even creating a secondary suite for rental income. Next, we have semi-detached and townhouses. Semi-detached homes share one common wall with a neighbor, while townhouses are part of a row, sharing two walls. These are generally more affordable than fully detached houses in the same area. They still offer a good amount of living space, often including small private outdoor areas. Then there are condominiums, or condos, which are individually owned units within a larger building or complex. Condos are typically the most affordable entry point into the property market, especially in expensive urban centers. Now for a critical component of your upfront costs, the down payment. In Canada, the minimum down payment required depends on the purchase price of the home and whether you are a resident or a non-resident. For Canadian residents buying a principal residence, the rules are tiered. For properties with a purchase price of $500,000 Canadian dollars or less, the minimum down payment is 5%. If the purchase price is over $500,000 but less than $1 million Canadian dollars, the minimum down payment is 5% on the first $500,000 and 10% on the portion of the purchase price above $500,000. For properties priced at $1 million Canadian dollars or more, the minimum down payment is a flat 20% of the purchase price. It's also important to note that if your down payment as a resident is less than 20% of the home's purchase price, you'll typically be required to purchase mortgage default insurance. For non-residents looking to invest in Canadian real estate, the down payment requirements are generally stricter, typically needing a minimum down payment of 35%. It's essential for non-residents to consult with Canadian lenders or mortgage brokers who specialize in these types of transactions early in their planning process. Section 5. Beyond the asking price, unmasking those additional costs. The property's price tag and the down payment are just the beginning. There's a whole host of other expenses, often called closing costs or hidden costs, that you need to budget for. One of the most significant is the land transfer tax, or property transfer tax in British Columbia. This tax is levied by provincial governments and sometimes municipalities like Toronto when a property changes hands. Then there are legal fees and disbursements. You'll need a solicitor or notary to handle the legal aspects of the property purchase, including reviewing the agreement of purchase and sale, conducting title searches, registering the mortgage, and ensuring the title is transferred correctly. Don't forget about property appraisal fees and home inspection costs. Finally, there are ongoing costs to consider even before you move in, such as property insurance, which is mandatory if you have a mortgage. Cumulatively, these additional closing costs can easily add up to 1.5 to 4% of the property's purchase price, so ensure you have these funds available on top of your down payment. Section 6, a real-world example. Tallying up your initial investment. Let's put all this together with a practical example to see how these costs can accumulate. Imagine you're a Canadian resident looking to buy a condominium in a city like Ottawa for 550,000 Canadian dollars and you plan to live in it. First, let's calculate the minimum down payment. For the first 500,000 Canadian dollars you need 5%, which is 25,000 Canadian dollars. For the remaining 50,000 Canadian dollars you need 10%, which is 5,000 Canadian dollars. So, your total minimum down payment would be 30,000 Canadian dollars. Now let's consider the additional closing costs. Land transfer tax in Ontario for a 550,000 Canadian dollar property would be approximately 7,475 Canadian dollars. Legal fees and disbursements might be around 2,000 Canadian dollars. A home inspection could cost 500 Canadian dollars, and a property appraisal, if required by the lender, might be 400 Canadian dollars. Section 7, Alternative Routes, exploring other Canadian property investment avenues. Perhaps the upfront costs of direct property ownership seem a bit steep right now, or maybe you're looking for a more hands-off approach to real estate. The good news is there are alternative ways to invest in the Canadian property market. One popular option is investing in pre-construction condominiums. This involves purchasing a condo unit before it's actually built, often securing it with a deposit structure that's spread out over time, rather than one large down payment up front. The potential benefits of pre-construction include locking in a price early, potentially benefiting from appreciation by the time the building is completed years later. Another avenue is a real estate joint venture or JV. This is where you partner with one or more other investors to purchase a property. A JV allows you to pool resources, share risks, and leverage each other's strengths. Finally, consider real estate investment trusts or REITs. These are companies that own, operate, or finance income-producing real estate. When you invest in a REIT, you're essentially buying shares in a portfolio of properties which could include shopping centers, office buildings, apartment complexes, or industrial facilities. Section 8. Top tips for budding Canadian real estate moguls. Alright, you're armed with information on costs and options. Now let me share a few practical tips to help you on your journey to becoming a successful Canadian real estate investor in 2025. First and foremost, get your financial house in order. This means checking your credit score, reducing existing debts, and saving diligently for your down payment and closing costs. Secondly, research. Don't just fall in love with a property, fall in love with the numbers and the location's potential. Understand the local market trends, vacancy rates, average rental incomes, if it's an investment property, and future development plans for the area. My third tip is to think long-term. Real estate is generally not a get-rich-quick scheme. While flipping properties can be profitable for experienced individuals, most wealth in real estate is built over time through appreciation and consistent rental income. Finally, always have a contingency fund. Having a cash reserve specifically for your property investments can prevent a minor issue from becoming a major financial crisis. Section 9. Taking the plunge. Your next steps to smart property investment. So, there you have it, a comprehensive breakdown of what it takes to invest in Canadian real estate in 2025. We've covered average prices, the different types of properties you might consider, the all-important down payment requirements for both residents and non-residents, and those crucial additional costs that often get overlooked. Understanding these financial aspects is the bedrock of any successful property venture. It's not just about finding a house, it's about making a sound financial decision that aligns with your long-term goals and capabilities. We also explored some alternative investment paths, such as pre-construction condos, joint ventures, and REITs, which offer different ways to tap into the potential of the Canadian property market. The key takeaway is that there's more than one way to build wealth through real estate. The path you choose will depend on your individual circumstances, risk tolerance, and the amount of capital you have available to invest. I hope this overview has given you a clearer picture and the confidence to take the next steps.